What I'm going to do today is talk a little bit about the asset class and its characteristics to allow you to think about how it might fit into your clients' portfolios. And then I'll flip things around. Rather than talking about the macro issues and what's going on, I'll talk about some of the options to get invested in the asset class and the Wholesale Australian Property Fund, as Chris alluded to, and the characteristics of that. And then I'll talk about the big things that are on people's minds in terms of rising interest rates, inflation, a lot of the themes you've heard today, but also some of the more specific ones around what's happening in the office market, what's happening with work from home, what's happening in the retail market, what does online sales mean. These are the sort of questions that we're getting and having to think about as we manage the fund, and no doubt you'll have had the odd client question from your client. So let's begin. Why might you choose to invest in commercial real estate? Well, let's face it, most people when they first think about real estate as an asset class, think very much about residential real estate. And that's because we're all familiar with residential real estate, we live in it, and a lot of people will have an investment in it on the side. And it's been a good asset class to be in, about 9% returns, most of that in the form of capital gains. And that's what the slide on the chart on the slide's trying to show, that both commercial property and residential property have both delivered about the same returns, but with residential, the majority of that return has come in the form of capital gain. You know, Sydney house prices were up 30% last year, whereas with commercial, the mix of the return is different. You get about, in the last 30 years, about 7% in the form of income, and your capital growth is more in line with inflation. Now, for a lot of investors, as they move out of the growth phase and start focusing more on the shorter term, the here and now, wanting some cash in their pockets rather than wanting to think about what the value of their investment might be in 30 years, that sort of prospect appeals to them. But it's not a one-trick pony. It's not just about income, although that's an important component. A lot of investors like the tangibility of real estate. You don't have any such thing as survivor bias. You know, there's no real estate here in the Sydney CBD that isn't worth more than it was 100 years ago or 50 years ago or even 30 years ago. There's no concept of land going broke. So the tangibility of real estate makes it appealing. And this was a feature of it that used to be talked about a lot, and that is it's an inflation hedge. You know, a lot of the institutions invested in real estate post-war when you had inflation running in high single digits or even double digits year on year, because it preserved the nominal value of the investment. It goes up in nominal terms when you have higher rates of inflation. And that has sort of fallen by the wayside as an attraction of the asset class, as all the chat's been about what's the RBA going to do to get inflation back up into its 2 to 3% target band, rather than what happens if it runs away. But it's a changed environment, and I think that is that is sort of something on clients' mind, is how do you guard against that? Well, real estate does that pretty well. And finally, one of the reasons that you can sort of trust the income is that it's backed by leases to commercial and government tenants. Now, overall, how does it stack up? It stacks up pretty well. You get a fairly low volatility versus other, say, listed investments, and a very, very respectable return. So that is, it sort of makes sense for a lot of people to have a think about commercial real estate as opposed to residential or other asset classes in the current environment. But the problem is it's very difficult to do. It's very difficult to access commercial real estate. First of all, there's the issue that it is chunky. You know, if you've got the typical SMSF balance might be $1 million, but you'd have to put all of it into a very, very small commercial property to get a direct exposure on your own. You know, $1 million really might buy one strata unit or a shop in a small strata unit complex. But equally, there's a lot of difficulties in terms of managing it. It's pretty easy to offload residential property to a property manager and have them take care of it. But with commercial property, there's a lot more you have to think about, and the bar is higher in terms of the expectations of regulators and the way you treat your tenants, etc. So we've had anecdotally a lot of people say to us that they don't mind the investment class, but when they got into it on their own, they came back and realised that it chewed a lot of their time, and that really they weren't getting sufficiently paid for that. And that takes some professional skill too. So rather than doing it yourself, you can go into a fund. Now the issue with, if you go into, say, a syndicate, that might get you a bit more diversification because you only have to put in, say, 100 grand or whatever the minimum is of the syndicate. But you're still only getting one property. You might get a few more tenants. And generally, those vehicles lock you up for a period of time, and they're leveraged. And that means that the returns, whether they be good returns or bad returns, are magnified. And therefore you don't quite get the same sort of investment profile as the underlying asset class. Now that might suit some investors, but if it doesn't and you want access to your money, then there's not a lot of options available, and that's a problem that we've tried to solve. So the Wholesale Australian Property Fund is an open-ended vehicle. It's been around since 1985, and that length of time has given it an opportunity to build up a very large portfolio. There's 26 properties. They're all along the eastern seaboard, over into Adelaide. We don't have anything in Western Australia at the moment, but that's on the to-do list for the next cycle. Some of them have long-term redevelopment value, but in general, they're generic properties that appeal to a very wide base of clients. The rent from these properties is collected, and once a quarter we pass it through as a distribution to investors. Over the last little while, that's been at a fixed rate. Since the pandemic came along, we fixed the rate at the rate that it was pre-pandemic, and so investors are getting the same check today that they were back in 2019. We invest in properties that are valued between $20 and $250 million, and we see that as a bit of a niche. On the one hand, up to that sort of lower level, the $20 million, you tend to get a lot of private investors bidding for assets on an auction basis, and that pushes the price up. Beyond that, a lot of investors sort of fall out of the market, and yet there's a bit of a gap to the range where the large institutions, the sovereign wealth funds, the offshore opportunity funds, and even the big domestic players start to come in. So we like that space because you've still got a wide range of good quality tenants, and if you can deliver good service, you can keep them happy, keep them paying the rent, and it sort of works all round. The fund's managed conservatively. We only use about sort of 20-25% debt at the moment, and typically it's been higher than that. It's been about 10% over the last 15 years. And importantly, investors can leave the fund on a regular basis. So I need to elaborate on that because this is probably one of the key things to look out for when you're investing in commercial real estate is how you're going to get your money back, whether that's investing directly or through a fund. In the case of the Wholesale Australian Property Fund, we have a Plan A, a Plan B and a Plan C. Plan A is to allow investors to leave the fund on a monthly basis, and that's what's happened for most of the last 10 years. We do that primarily because people are always coming into the fund. We typically take about $1 million in new applications every day. But we also recognise that there'll be times where that tap is turned off and more people want to leave the fund than come in. For those circumstances, we hold a large debt facility and we'll only use part of that for acquisitions. So in other words, we keep a big chunk of it in reserve for a rainy day, a March 2020 that comes along and people want to, naturally go to cash, then we've got a bit of a reserve for those circumstances. We also hold a REIT portfolio, though that's quite low at the moment. So if that that's our Plan A. But we also have a plan B, which says you can get your money back within 12 months. And in March 2020, or April 2020 it was, we reverted to plan B because we're in a crazy environment. We always had the money, we always had plenty of money to let investors out. However, it was such a uncertain environment with borders closing and not being able to visit family and schools not being open, all of that sort of craziness that we weren't used to. We decided that it wasn't a good idea to be paying investors out under those circumstances when you've clearly flagged that there is a plan B option. So for 4 months, we restricted the redemptions in the fund, and then by either August or September, we'd paid everyone out, and we continue to pay everyone out on a monthly basis to this day. And then finally, under Plan C, there's legislation in place that means that real estate funds, in fact a broader range of funds, can be locked up, and in those circumstances, investors wouldn't have the right to their money back, and it'd be up to the responsible entity to come up with a new plan based on whatever circumstances you're in at that point. Now that's a nuclear option. We've sort of managed to avoid that in the last 2 or 3 years, and I'd like to think that we could avoid that in the future too, but it's a possibility. So in the last 35 years, the total return's been about 9%. It's been a very strong year in the last 12 months, and we might talk about some of the reasons for that. But if you take a 3, 5, 10 or 35-year track record, it's generally ranged between 7 and 9%. And there's a pretty simple reason for that, and that is shown on this chart. If you're getting 70% of your return in the form of income, and the income's coming from the tenants, if you can keep the occupancy rate high, then you're going to collect that income, you can pay it through, and it's a fairly simple formula. So for the last 15 years, the portfolio occupancy has been at or above 95%. And I think a lot of clients sort of take comfort that they can sort of understand that. That's where their return's coming from. I can actually see it. We hold about a third between office, retail and industrial. Now, industrial has been a pretty fortuitous place to be in the last 2 years. That has really boomed, and we might talk about some of the reasons for that later in the presentation. The underlying cash flows are contracted rents that are tied up to leases, and they come from some of the tenants that you see on screen. So again, very familiar names: Coles, Woolworths, Land Rover, Visy, Kone. I'm sure you've got in a Kone elevator, or even Dentsu Aegis, a massive group out of Japan. Now, the number in the top right, I think it's right for you, yep, is the percent of fund revenue that each of these tenants account for. So you've only got one tenant that's at 5%, all of the others are less than that. So you're really not betting the house in terms of if a tenant decides to move out or they go broke. There is not a huge amount of risk with any one tenant. So again, if you're thinking about the options as to how you access commercial property, that fund structure might be a good idea. Now, in terms of the assets, that by nature illiquid, so we've really got to anticipate issues, and it's been a pretty strange time in the market, and we're getting a lot of questions about some of the macro themes that we've heard about today and how they might impact real estate. Now, the first, which is probably most topical, is what happens if interest rates rise. Well, let's start with a bit of theory first. The way real estate is priced is very similar to bonds in that you have what's called a capitalisation rate. That's a number, call it 5%, and that if that number falls, then values go up. If that number rises, then values go down. Now, there's two differences with bonds. Firstly, with the bond yields, the yield is the yield. With the cap rates, there's a margin applied to that yield, or a spread. And so it's not necessarily the case that just because interest rates move, cap rates move. They tend to move in the same direction, but equally they can move independently of each other, in which case the spread will either get bigger or smaller. And that's sort of what's happened over the last couple of years, is that interest rates have come down and cap rates have come down too, so prices have gone up, but they haven't gone up by as much as interest rates have fallen, so that spread's got wider. And that gives you a bit of buffer if interest rates start to move the other way, that you wouldn't, even theoretically, expect values to fall just based on that, because there is a bit of margin to play with, in the order of probably 75 basis points. So that's one difference to bonds, and that's sort of one reason that values might not be falling just because interest rates are rising. The other, arguably more important reason is that a big difference with bonds is that with a bond, that the dollar amount that you receive is printed on the certificate. With real estate, it's linked to the rents that you're able to achieve. Now, if interest rates are rising because the economy is booming, then rents are probably rising too. If interest rates are rising because you've got a lot of inflation around, then typically, again, rents will capture that, perhaps with a lag, but they'll generally capture that growth. If I could relate that into the retail sector, it's probably easiest to understand. There's a whole sort of pseudoscience about what tenants can afford to pay. So supermarkets would typically pay what's called a gross occupancy cost of 3%, which means that their rent is in the order of 3% of their sales. With the specialty tenants, for smaller properties, you could expect that to be in the order of 10 to 12% of their sales is what they can afford to pay in rent, and with some of the larger properties it might go up to 17 or 20%. But either way, irrespective of what that is, that's they're sort of fairly stable rules of thumb, and it implies that if you have inflation around and people's revenue or companies' revenue increasing, you can capture that in the form of rent. Maybe it might take a little bit of time to come through, but you can capture it, and that's what makes real estate a pretty good hedge against inflation. Another sort of major question that we're seeing is, okay, what happens with the office market? Clearly, the rate of with which people are utilising office space isn't what it was pre-pandemic, and there's some pretty obvious reasons as to why that is. But okay, what does it all mean? I think, well, let's skip down to the bottom line. I think it means that demand shrinks. There's a step change down to a new level. We have to sort of figure out what that level is, and we're probably pretty close to doing that. And then we march on as before. The economy grows, we get migration back. Off that new base, there'll be the trajectory should resume. So how much does it shrink? Now, if you were to say, what is clear after 2 years is that companies, governments, organisations want their workforce in the office. They see productivity benefits, they see ideation benefits, they see cultural benefits, they see lots of benefits. But on the other hand, it's also equally clear, and this is a global phenomenon, that that employees like that flexibility, and they're not coming back to the office on a 9 to 5 Monday to Friday basis like they were pre-pandemic. So if you were to say we all move to a 3-day week, that implies a 40% drop in demand. Now, I don't think there is going to be a 40% drop in demand, because that implies that we sort of all spread out over the 5 days and you can get the full efficiencies in terms of your office use. Now, it won't surprise anyone that in the room to hear that what people like doing is taking off a Monday or a Friday or both. And that sort of gives them a bit of an alignment with the companies that actually want them in the office at the same time. That's not such a bad thing. But that means you've got to hold a desk for everyone to come in Tuesday to Thursday, even if those desks are going to be underutilised on Monday and a Friday. So I don't think you're going to get a 40% drop. What's more, the way we use the space is changing, and probably requires us to start getting more space per employee or user than has happened in the past. For the last 20 years, the amount of space per employee has dropped from about 20 to 1 when, back in the late 80s when, everyone had an office, to around 14 to 1 as open plan workspaces became more prolific, and then into the order of 6 to 8 on a pre-pandemic basis for some of the modern developments that are sort of making smart use of co-working space and third spaces and the like. But it's been coming down. Now, you could see that trend reversing because now, and we are seeing it's starting to come through in modern fit-outs, that you need more space per employee because every meeting has to be digitally inclusive. There's a lot more Zooms or Teams meetings. That can be very distracting if someone's talking away at a desk, or particularly if maybe two people in different parts of the room are sort of having the conversation and there's a third at home. It's very distracting. So you need more quiet spaces, booths, excuse me, and meeting rooms. Equally, you need to entice your employees back because they don't like coming into the office, mainly because of the commute. So having, it's likely that you're going to require more space per employee. The other thing to note is that there's a lot of parts of a lot of big office users that have actually done very well out of the pandemic. Government is the biggest office space user in the country, and at every level they have expanded, as we all know. And shrinking them back into the box is, no easy feat. So they're likely to maintain a higher level, a higher footprint than they did pre-pandemic for quite some time. Equally, IT's done very well. Equally, consultants have done very well. And we're also seeing more demand from groups that are looking to place regional headquarters into Australia in preference to Hong Kong, where there's been a whole change in the whole political climate there, and that's a bit of a two-way street. Corporates are less inclined to go there, and it's more difficult to get visas to go there if they wish to. So that's probably going to redirect some traffic to Australia and Singapore. What does that all mean? I think 2 years down the track, we're in a position where you're starting to see, and you've had a chance for supply to adjust. The chart on screen shows our forecast supply pre-pandemic and then post-pandemic, and it basically halved. So I think we're pretty close to finding a base. It might be a bit choppy in terms of rents, in terms of a bit of a arm wrestle between landlords and tenants, but we're close now that we're sort of through the vaccine program and governments have only just lifted the restrictions on the public health orders saying that you had to work from home. I think you come Easter, you get a bit of a catalyst to come back into the office, and we'll start to see where things are at. But rents have already fallen about 10 or 15%, and I suspect that's about the right figure. And from here, the ordinary market dynamics of supply and demand will start to determine individual markets, rates of rental growth or otherwise. But we're back to a sort of more normal circumstances, even though we're not quite in a position where the occupancy rates have fully recovered. The other question we get is what happens with retail? Will online kill that? I don't think it will, but you do have to, as we see retail, you want to be either hitting from the baseline or playing at the net. You don't want to be caught in the middle. And what do I mean by that? I mean that on the one hand, if you're hitting from the baseline, you want to be in the largest, sexiest centres that are places that people go, not because they have to, but because they want to, that have got real investment in getting the top brands there and making them places that you can eat, get entertained, have a good time, enjoy yourself, socialise with friends or with family. The examples might include Macquarie Shopping Centre or Bondi. These sort of centres have a lot of appeal to tenants and to consumers. On the other hand, if you're not that, then you probably want to be the small localised centres that offers convenience, that you can go to, you can roll up, you know you can park easily, you do your $30 basket shop, you might get some other stuff while you're there, and equally though, it's a place that you like going to. And we've really positioned for that for the last 6, 7 years rather than the last 2 years coming into the pandemic. Within the fund, we're hitting from the net. We don't have the big centres, we've got the small centres. But we have changed the mix so that there's far less general retail, fashion and the like, and much better fresh food offers and services. Traditional services, banking, dry cleaning, government, yes, but more than that, moving into medical, so doctors, facilities, chemists, pharmacies, etc. And then specialists, audiologists, physiotherapists, dental, orthodontry. You find all of those in these sort of centres. And then finally personal services, grooming, nail bars, Pilates studios, gyms, etc. All of these are in the mix, and they're pretty online proof because you just can't do them over the internet. So if you only have 30 or 40 shops to fill, you can quickly get to sort of 50 names that might potentially fill them. And that's what we've seen through the pandemic. They've stayed full. They haven't been dramatically impacted, except where you've had extreme lockdowns. But ignoring that, they haven't been dramatically impacted, and that income has proved resilient in being able to kick out a 5 or 6% yield, even in difficult times. They say industrial is the new black. That has been a very popular asset class and has done very, very well. The fund's returning about 15% at the moment. That's sort of over and above what I'd normally expect. I'd normally expect somewhere between 7 to 9, and it's largely through holding industrial assets. There's a pretty simple reason for that, and that is that we've got this boom in e-commerce, and that sort of been a fundamental shift that's been accelerated by the pandemic and has meant that the investment market and users have really gravitated into that space. There are a couple of things to be wary of though. You want to be wary of obsolescence. There's going to be winners and losers through the cycle, and at the moment I think everything is in the winners category, but I'm not sure it's going to play out that way. And the other thing to be wary of is that you do have a bit of a surge in demand, because there's been a shift from in the last couple of years away from just-in-time logistics. So just-in-time sort of got popular 20, 25 years ago, which is where rather than holding warehouses full of inventory, you order what you need when you need. It comes from offshore or wherever it needs to come from through very sophisticated logistics lines. It's there, it's arrived, and you send it straight out to door into the market. Now, that's worked pretty well until it didn't, until supply lines were interrupted, or manufacturing of components around the world was, majorly disturbed, which meant that the stock wasn't available. And that business interruption is a bit of a lesson learnt. And so you've got a lot of groups looking to take warehouse space to stock up and to hold a bit more inventory than they were previously. And if everyone's doing the same thing at the same time, you get a bit of a surge in demand, and we're seeing that at the moment. Now, beyond COVID, I think it's a really interesting time. At the moment, as I've mentioned, the last 35 years, we've just invested in office, retail and industrial. But the way we use space, both in a personal capacity and in a commercial capacity, is changing. And we are likely to shift that mix over the next 4 or 5 years to downweight the office, retail and industrial from a third to a quarter, and add in some of the newer asset classes that have really been given, vindicated by the investment market, and pick up on some of these major demographic, economic and technological trends. So healthcare is an obvious example of that, but there might be other things that aren't so prominent, like co-living, which is really a reinvention of boarding houses. They have sort of small apartments, 22 square metres per person, and they're closely related to build to rent, which is another new asset class that's sort of come onto the radar. And equally, land lease is an interesting area. So with land lease developments, what happens is that the owner of the property will own the land, but the tenant will come on and construct their own house, usually fairly modest accommodation. But I think that sort of investment is relevant for the next generation, where we have a huge issue in that a lot of people are capital rich but cash poor, and they need to somehow cash that out in order to fund themselves because aged pensions won't keep up. Student accommodation is another area of interest, as is special disability accommodation and data centres. Now, pleasingly, within the portfolio, we've got a lot of opportunities to do this with the properties that we own. A lot of it is complementary to the use. So adding childcare to a retail centre is a good thing for childcare, because you can go and do your shopping at the same time. It's very convenient, but equally it's a good thing for the retail centre because it adds to your sales. So these sort of areas are the ones that we're going to focus on in the next 4 or 5 years. Now, I've got a few more slides to you, but I might skip past them because I'm conscious of time, and I want to show you a video that sort of brings all of this to life. But before I do, I guess I'd summarise to say I think the asset class is going to be suitable for a lot of clients because of those two components of return. You've got maybe 5 or 6% income, and that's backed by contracted to leases to major government tenants and corporates. On the other hand, if you're only expecting, and we're only sort of guiding towards inflation-style growth, you tend to get that, and having a hedge against inflation is a good thing for all the reasons that you've heard through the various presentations today. As advisors, I think the trick is how do you get your clients into the asset class when there's some significant hurdles, and I think the amount of liquidity that you have and the amount of debt are two big considerations. And finally, I'd say that the third reason to maybe consider investing in real estate is that clients ultimately generally just sleep well. They understand what it is. They understand it if it goes well. They even understand it if it doesn't go so well, and they like that element of it. And with that, I'll play a short video, and thank you very much for your time.